Thanks for having me. I'm glad to be here today. My name is Chuck Schott, and I'm the Chief Technology Officer of Invenium Capital Partners, and I'm the President of our Invenium IO platform team. How do you bring private debt issues into the public view? That's public exchanges, being able to trade those publicly, bringing that value and liquidity to these markets that are relatively underserved. And we'll go into some detail on what those markets are, but I'd like to start by asking a question. Now, we're a fintech company, and that too is an overused term, and oftentimes it means a bank that has an IT department, and sometimes it means a bunch of guys from a failed food delivery startup who decided if they put Fin in front of the name of their startup's tech, that they'd have a financial business. So I'm primarily on team tech. I'm joined today with Pat O'Meara, our CEO, who is our team Fin representative, and Diane Moss, who runs our Invenium Gibraltar office. But I'd like to take a poll in the audience. Who here thinks of themselves as on Team Fin? Raise your hand. Okay, who thinks of yourself on Team Tech? Raise your hand. All right, what do the rest of you guys do? Okay, so it's two hands. Okay, so that's a pretty even split. So I'll try to make sure that we talk about things both at a high level as well as some of the details that we've discovered as we've gone along. But I'd like to tell you first of all the opportunity that we're looking at. We identified early on that probably one of the biggest markets out there that's underserved is the SME private debt market. That's small and medium-sized enterprises. And to put it into context, and somebody will correct me on these numbers, I'm sure, but rough guesstimate, the current size of the cryptocurrency blockchain DLT market is roughly $500 billion. As of sometime last year, the global private debt market was on the order of 100 times that, or $50 trillion. So certainly solving the problem of bringing private debt to public markets by way of the blockchain is something that would potentially bring a 100-fold increase in the value of the market that we're all interested in. To put the problem into another perspective, there's been a change in banking over the last several years where the regional banks that used to serve small and medium-sized enterprises with loans that are anywhere from $5 million to $250 million have consolidated. This is an example of a lot of the banks that are in the US market, but the reality is it's happened all over. We've had discussions here in Gibraltar about banks that have consolidated and moved in or out of the market. And the challenge that presents is that they're now too big to pay attention to a $50 million size deal. It takes just as much effort to do a deal of that size as it does to do one of $5 billion. They'd rather go get the fee off of the $5 billion deal. And we find that these small and medium-sized enterprises are greatly underserved and are having challenges raising capital. And that's unfortunate because if you look at the key point on this chart is that almost 92% of the jobs that have been created since the 2008 downturn have happened in the SME marketplace. That means that's where the growth is, that's where the engines of everybody's economies are, and they're getting ignored by the financial industries. So Invenium has taken as its charter to try and figure out how to automate and improve the process, and part of that is to make the SME debt more valuable. We do that in a number of ways. We have highly automated processes that help issuers get their offerings to market in front of a wide range of investors. And we've spent, 9 months or so working here in Gibraltar with the stock exchange, with the regulators, with members of the business community to accelerate that process onto the blockchain so that you can actually take advantage of all the economies that are given to you by being on the DLT. So to get on to the subject, we want to talk about what are the problems facing getting debt on the blockchain. And I would give a great debt of thanks to the previous panel who teed up the problems nicely. And I think we actually have solutions for a lot of the things that they identified as problems. But first of all, as I mentioned, these SMEs are underserved, and we have to find a way to tap that market. One of the things that makes debt on the blockchain challenging is that the transactions are not simple, and they're never the same twice. Any given issuer has a different set of requirements, different use of proceeds. The investors are interested in different industry areas. No two deals like this are the same, and unfortunately, the basics of the blockchain say that all the transactions better look like a token transfer or a coin transfer. And so you've got a hammer that really can only go pound coins and tokens, and we're talking about being able to pound bonds and debt issues and other sorts of things that are much more complicated. As the previous panel pointed out, there is a problem with liquidity for these investors, not only from the primary issue, but also any secondary market that might exist. And that partly comes about because these are not generally visible deals, right? They're done Rolodex to Rolodex, word of mouth phone calls. It's a very high touch process, and one of the components that we wanted to bring to the process is an actual marketplace where you can come and find these deals and participate in them in perhaps a fractional way as opposed to having to buy a traditional whole loan like you might do as an investor in a normal debt deal. And one of the ways to really bring the liquidity is if we can tokenize that debt and trade it as a security. The fourth point here, the current technical approaches. I could go spend an hour talking to you guys about how the blockchain 1.0 environment is not even at Internet 1.0 level. Everybody makes the analogy of blockchains, Internet 1.0, we're moving to 2.0. We're not even to 1.0 yet. Ethereum and Bitcoin and all of the other DLT solutions, dozens of different tokens, are really analogous to what would have happened if the internet had TCP/IP and SNA and Novell networks and modem protocols and carrier pigeons as ways to travel data around on the internet. And that they were all still in play today. And you didn't know whether you needed to plug the round peg into the square hole to talk or anything. Luckily, we had standards bodies and a lot of concerted effort early on in the process, some from government entities, but a lot of that was from academia and private industry that established standards that made that substrate common, which let the next level of applications happen. We standardized on a communications protocol. We standardized on protocols like HTTP and email protocols so we could communicate messages at a standard level. Right now, if I've got a business that's based on the Ethereum blockchain and I use smart contracts written in Solidity, they're useless on the Bitcoin blockchain. There's no commonality. There's no way to interact with that whole separate economy. So one of the things that's missing from this industry actually is something that the internet did right, which was to have standards bodies, not government regulatory agencies, but we had standards bodies like the IETF, the Internet Engineering Task Force, or the IEEE, or ACM, or other groups that helped bring people together to define the standards and say, this is how we're going to do this level of work. Let's move up the stack. This is how we're going to do this level of work. What we've discovered, particularly in trying to tokenize debt, is that the standards that are in place now were developed over a period of the last 5-8 years by people that were essentially enthusiasts in the cryptocurrency space. A small group of people got together and did the first Bitcoin implementations that were widely used. Ethereum was done by a relatively small group of people, and not to discount the value that was created, but they forgot some things. And maybe if they'd asked some other people in a broader environment, we wouldn't be in the situation that you're going to see with tokenizing debt, because quite honestly, even the best blockchains that are the most widely deployed make it a challenge to do this in the context of just the tools that they provide. So let me give you an example of something that we've done recently. Excuse me. We've actually gone through the process end to end of building a system that allows you to originate, structure, distribute, and issue tokenized debt. So we have all the tools in place, all the plumbing, all the piping, all of the processes that we use, and we found that unfortunately we're a little bit ahead of where the exchanges and the regulatory market are. The very reason that we're in Gibraltar is because if I looked around the room and pointed, at some point during today, all the players have been in this room that can solve this problem. Here in Gibraltar are regulators that are interested, government officials that are motivated, people that are setting up exchanges and other blockchain businesses that would implement the pieces that aren't quite there yet. So this is really exciting to me because it's been a long time since there's been a technology wave like Internet 1.0. And even though my contention is we're not quite to 1.0 with blockchain just because of the maturity of the technology, we could go to Internet 3.0 in Gibraltar before anybody even gets out of the gate, just because of the confluence of all the people that are here. So let me tell you what we did. This is an example, and to put it into realistic terms, this is a commercial, it's a commercial residential development in Florida that's about a total $50 million deal. And we've tokenized the first tranche of that, which was a $6 million deal, and it just completed last week. But one of the things that we wanted to do with this was do it in a way that is the way we would like to see these deals get done by everybody in the future. And one of the really critical things that we discovered early on was the value that you create in doing a deal on the blockchain extends far beyond just the token, or far beyond just the coin or the data manifestation on the blockchain. When we do a debt deal, there are dozens of people involved: lawyers, accountants, people on the issuer side, investors, people that are doing the structuring of the deal, the people that are involved in distribution, and all of those people have compliance requirements. They all have documentation artifacts that they create. Their actions, just talking to one another, are oftentimes things that need to be captured. And so we had to come up with a mechanism to model these complicated financial transactions in a way that the transactions themselves are, yes, they're repeatable. We don't want to do it twice, but they needed to be done in a way that other people in other industries could utilize the information that we collected. Our audit trail of compliance activity that happens in the system is useful to regulators. The due diligence work that we've done and the appraisals and the documents and everything that were created are useful to investors in the secondary market. They can go back to the work that we did and find it on the blockchain and say, oh, look, this deal is well structured. Here are the terms. Here's the company's financials. Here's their performance over the last 8 quarters. I can invest in this with assurance. I don't have to go read some white paper and hope that the data's all in there. I can actually go back and find the original artifacts that were provided by the company or the team that was doing the due diligence. So making that what we call an event series, a series of all the events that have happened on a deal throughout the life of the deal, is a very important part. Now, yes, we did issue ERC-20 compliant tokens that represent the bond denominations of this deal. I think for this deal so far we've issued, I think it's $50,000 tokens. Is that right, Pat? And they're out on the DLT. You can go out and see the transactions. You can see whose wallet holds them, tied into our software as a way to view it and go back to the deal artifacts. That's really the crux of where we'd like to see this go. If you have a token for a particular debt deal, you should be able to follow that back to all the artifacts that created that deal. You should be able to see who was on the deal team, who were the lawyers that structured it, who were the people that bought the first issue. That all should be out there and should be accessible. And that's part of the value that's created. It's not just the token, it's this long tail of valuable data that hangs off the token that is the full package that you get. I mean, you wouldn't go buy a secondary debt issue with a flimsy piece of paper that said, well, here's what we think it says, right? You'd really want to see that whole legacy of all the information that's back behind it. So we've gotten it to the point now that it's tokenized, the data's on the blockchain, the regulatory compliance information's all on the blockchain, and I have a slide later that shows how we did that. It's ready to be listed and traded. So we're very anxious to work with all the players in the room to figure out how are we going to list securitized debt? How is it going to trade? And one of the things that we've run into, which I think I have on the next slide, no, it's one after this, is there's actually some shortcomings in the ERC-20 model, and we've come up with some extensions to that. So let's talk quickly about what it takes to tokenize a debt deal. Well, you need some kind of technology platform. You're not going to do it with your Mist Ethereum wallet. That's not enough software to tokenize a debt deal. You have to capture the activities, you have to save the artifacts, you have to have deal rooms, you have to have KYC, AML, all those checks have to happen in a structured environment where you can capture it. So there's some platform beyond just the basic 0.9 version of the blockchain. The distributed ledger is really there to provide the trust and transparency, the visibility into what's transpired, not just a place to record financial transactions. You need that permanent record of all the actors, the actions, and the artifacts that they created. Those deal documents are worth a lot of money. either to the issuer because they get a better rate because it's a well-documented deal, or to the investor because now the asset is more liquid in the secondary market because it's well-documented, and I'm more likely to be able to sell it to somebody if they have a degree of confidence that the value I say it has is what it has. And then finally, the well-defined integrated business processes with exchanges and regulators. That's the point that we're at. We've done all those other things. And we're happy to share with people how we did that or do it for them if they need help. But this last bullet is where we're at, where nobody's had to do this before. I think we're probably the first company that's done an end-to-end debt transaction that is ready to be traded as a tokenized security. We even did it for ourselves. I think we're the first company in the US to use the new Delaware equity tokenization regulations to tokenize our own equity. Our entire cap table structure for 7 or 8 different classes of equity are all burned on the blockchain in ERC-20 compliant tokens, and all of our investors and shareholders have wallets with tokens in them that represent their ownership stake in Invenium. So what we came up with to solve this problem and help move the ball forward with exchanges and regulators and other partners is using ERC-20 tokens to represent the, this slide didn't come out too well. I apologize for it going off the bottom of the screen there. I'll read what it says. You can use normal ERC-20 tokens and smart contracts, but they're only okay for value in cash-like transactions that are bilateral, two-party. I'm giving you something for something else. When you look at trying to use a smart contract to model a very complicated debt deal, the code breaks down. You end up with errors, with problems. And I can't fathom what happens when people who claim that the code is the law try to go before a judge and adjudicate a 500-page smart contract source code listing with a judge. I don't think that's going to get very far. So what we've done is come up with a concept of regulated contracts. These are off-chain workflows that we automate that represent the steps of a debt deal that happen in an orderly fashion, that capture information, that persisted on the blockchain, and use companion smart contracts that are on-chain to actually persist the data. And I'll show you a picture a little bit later that is really what's going on there. And then finally at the bottom, this produces what we're terming regulated tokens. And we've been doing this probably for about the last 4, 5, 6 months. And only recently this month we've seen some other companies pop up with the same realization. ERC-20 is missing a critical piece. And that critical piece has to do with something that you do with a security style token. And there's no model for it in Ethereum. And that is, what happens if you have stock and you lose the stock certificate? Well, you sign an affidavit that you've lost the stock certificate, you send it to the company sends you a new stock certificate and voids the old one. There is no such mechanism for that with ERC-20 tokens. If you lose the token, too bad, your token's gone, sorry for you. And you can look, if anybody can ever figure out the private key for the address 0 on the Ethereum blockchain, you're $70 million richer, because there have been $70 million worth of mistakes where people dumped Ethereum into the 0 address. So, and it's gone, can't get it back. Well, we don't want people who hold bonds or bond equivalents in the form of a token to suddenly lose that ownership. They should have the same facility to go back to the issuer or the registrar or whoever is acting in that capacity, the exchange, and say, hey, I lost my wallet. You've got a record that I have this, issue these tokens. So we've done an extension to the ERC-20 contract standard that provides 2 functions: the ability to reclaim tokens from people that aren't supposed to have them, or the ability to basically destroy and reissue tokens that are lost. And then the real critical piece, and this is key to having a good integration with the exchange and with the regulatory processes, is the current ERC-20 token standard lets you move tokens between a buyer and a seller at the request of an exchange, for example, and it just happens. No KYC, no AML, no adhering to the covenants of the bond, whatever the issues might be. You don't have a way to enforce that in the smart contract. It's not there. So if some exchange decides to facilitate a trade of your token, now you don't know who your bondholders are. They don't know who you are. They don't know how to get the interest payments that they're owed, or the reports or whatever. So what we've implemented is an extra method in the contract that says this exchange wants to facilitate this token between these 2 parties. Interested third party who regulates this transfer, can you please approve it for us? it's all teed up, it's going to happen. It's just waiting on a third party to say, yes, I know both these parties, it falls into the covenants, go do that transaction. So if you were going to be an ERC20 token compliant exchange, we would ask, hey, one more step is add this method so that when the trade happens on a restricted type of token, that the check's done. That'll make all the difference in the world in being able to model these more complicated transactions on a blockchain like Ethereum. So let's talk about a little bit more about what's under the hood and how we did this. So I talked a little bit before about workflows. These things are not things that you want to try to write by hand. If you've ever tried to look at a Solidity smart contract, you don't want to be doing that if your day job is to be a lawyer or an accountant or most normal humans. There's people like me that might want to write it, but even I prefer to do this. We came up with a drag and drop way to have blocks of functionality that represent steps in our smart contracts. Some of those blocks map to actual smart contracts on the blockchain. Some of those map to steps that we do internal to our system or our manual steps that someone else does. But the net result is that we have a very well-defined, very well-structured data model for how you do a debt transaction from start to finish, from onboarding an issuer all the way through the primary and secondary sales. And normal humans can drag and drop the blocks so that if you're a law firm and you specialize in structuring a particular type of deal, you may have workflows that model the way that you work, and you can combine those with the company that's doing the banking, and now you have a workflow end to end, and because of the system's design, all these transactions are transacted against the DLT and records are made so that you can go back and see all these steps were done, here's who did them, here's how long it took. Not only is it beneficial for compliance reasons, in the future as more and more deals get done using this type of contract mechanism, the data pool becomes huge. There's an enormous amount of value created in this type of deal takes this long. This is the industry that's looking for this much money in these particular areas. Here are the investors that like to invest in these industry sectors. And you have a huge big data opportunity to present deals to appropriate investors, to have issuers be able to get money faster, have regulators be able to look at, this is a known problem type of deal, here's where you look. The system can learn from the pool of data that it's got. This is an example of the handoff between a company like us issuing the debt and a company like the GSX who's going to list and or trade it. I don't want to go into too much detail on this, but a goal for us would be to have a process that says we as the people who are structuring and issuing the debt are going to go through an automated process creating this legacy of information on the blockchain. We'd like to hand it right over to the people at the exchange who approve the issue, who do the trades on the issue. We'd like to have that same electronic infrastructure be available to the regulators to get in and look at the results and make sure everything was done according to Hoyle. So this is just a high-level example of some of those workflows executing in concert to pass data back and forth, not just within our organization, but perhaps cooperating organizations as well. And I'd said I would show you how we capture the data out on the DLT. If you assume that all of our stuff or all of any issuer stuff is over there on the left-hand side and we're executing regulated contracts to do some financial deal, we produce a series of events. Some are related to deal 1, 2, 3, whatever they are. And we bundle those up on a regular basis as a whole set of transactions. We sign that set of transactions and we burn a reference to it on the blockchain, and we have viewers within the system that you can come back and look at and say, hey, this is 2 days worth of work on this particular deal, and you can unwind it and see who did what and when it happened and that it really happened. And it's out there forever because the reference to the data and the checksum of the data is on the blockchain. We've got it off in a repository. You can come in and say, well, does the checksum match? Then this is the same data. Let's go through it. That's probably, at least to the point we've gotten to now, as far as we've gone. And I guess I'd like to see if anybody has any questions about this. Given that I could talk another hour, I'm sure there's probably a few. Sure.
Where do you store the data?
So the question is, where do we store the data? It's really expensive to store large quantities of data on the physical blockchain. And so one of the things that we had to come up with was a way to store trusted data off the chain. We use Amazon's S3 buckets hashed to references that are on the blockchain through an interstitial database that we have. So it's off chain, but it's linked to the chain in a way that's provably not been messed with.
Hello. Angus McNee. I had a question. You mentioned what sounded like a third-party custodial exchange for data, and previously you mentioned an ability to reclaim tokens. I'm wondering if that's one and the same, or if that's something else.
It could be. It could be, and it probably in most cases would be, because you would only reclaim the tokens in a situation where it was lost, or the wallet was stolen, or there was some other bad action that meant that somebody was in possession of tokens that they shouldn't have, as if it was stock certificates that were taken out of a safe deposit box by somebody or whatever. So that's one of the mechanics that we need to work out with the exchanges and the regulators. But that's right; it's the same function. Anybody else? So feel free to grab myself or Pat O'Mara after the discussion if you'd like to talk more. And otherwise, thanks, Pete.
Chuck, thank you very much.
Appreciate it.
Thanks a lot.